All right, everybody, let's talk about gold and the economy for a second, because gold is one of the best gauges for determining the health of the current economy in other market cycles and things like that. Okay, so in general, the way it works is that, let's say we're going through something like 2008 financial crisis, something of that sort. It's just a little bit scary. You know, the market is crashing. The economy isn't looking as good as it has in recent past or something like that. People start moving their money out of more riskier assets, such as stocks and other equities of that sort, and they start moving those funds into what's known as a safe haven asset, and the most popular one of those is gold. When that happens and a lot of money is moving and exchanging over to gold, the price of gold starts going up. So when you see the price of gold start going up on your charts or whatever it may be, that may be an indicator that the health of the economy is going down a little bit, or at least the outlook for the economy is going down a little bit. Okay, just like the stock market, the price of gold moves up kind of based on future expectations. So a lot of times when people start seeing things falling into place that look like, okay, the economy isn't going to be so great in the near future, or maybe we're about to have another financial collapse of some sort, all of a sudden you'll see the price of gold start climbing, because that is a safe haven asset that people want their money to be in to protect their money during that time period. And then vice versa, when the health of the economy starts getting better and the outlook for the near to mid to even long-term future starts getting really good, it starts going the other way. Gold starts going down because people don't want their money in something like gold, because they look at it as opportunity cost, because that's a safe haven asset. That's not a way to make money, it's a way to protect money. So when the economy's looking great, they'll start moving those funds out of gold and putting them back into the stock market and other equities and things like that that are a little bit more risky. Okay, so that's a way, just looking at the price of gold, that's a way that you could kind of determine or gauge the current health of the economy or other market cycles. So let's take a look at some specific examples really quick. In 2016, gold prices rose $100 an ounce in just 6 hours. This was due to the shocking Brexit vote, which led investors to panic. Prices rose from $1,254.96 at 4 p.m. on June 23rd, which was the evening of the Brexit vote, to $1,347.12 by midnight. That's because investors bought gold as a hedge against declining currencies such as the pound and the euro. Okay, so on September 6, 2011, gold reached its record of $1,921 an ounce. Many variables contributed to this, including weak jobs reports, the lingering Eurozone debt crisis, and continued uncertainty around the U.S. debt ceiling crisis. And this led to, again, the peak price of gold, $1,921. In 2009, the price of gold rose to $1,000, and less than 2 years later, it doubled more than that. Of course, one of the most important days in gold price history was when President Nixon detached the U.S. dollar from the gold standard in 1971. Gold prices skyrocketed from $42 to $122 an ounce very quickly. So as you can see, market conditions play a huge role in determining when it's a good time to buy gold or sell gold. We teach that in detail at Safety Step Protect Your Future, our online course about precious metals investing, so that you can again use the market conditions in your favor. It's one of the most important keys, one of the most important factors when it comes to investing in gold and silver. And again, it's just a simple way to gauge the overall health of the economy. So you can take that information, go start looking at gold and silver, and see it for yourself exactly how they react to the economy, to the U.S. dollar, and things happening around the world.